Recording in progress.
All right, guys, sorry about the late start. Got caught at the bridge a little bit and technology wasn't as easy as I thought. So we have a lot that we could cover, as Donnie said. We want to keep it kind of open interchange. I want to kind of customize and pivot to what you need to see, what you don't need to see. It's going to be much different for Bill and Rick, and then Bobby. Richard's going to have no idea. You guys might have a little bit just from having a couple of licenses. So I want to try to resist the temptation to get into too much of unnecessary details. Give you a little bit of background, get into a little bit of concept, and then dive into the practicality, and then we'll kind of pivot as need be. If always I've got the whole presentation that you can poke through, it's definitely everything in one place, so we can go on for forever as needed. Let me see if this is going to actually work like a slideshow. Otherwise, we'll just maximize the screen and we share and do that. All right, we'll see how that goes. All right, so obviously we're talking about managed accounts. So our proprietary program is called the TFS Managed Account Solutions Suite. It is an integration of a lot of different technologies, programs, people, activities, and this is just really kind of giving you a quick snapshot of what it is. The main engine behind it is powered by InvestNet. We're going to talk a little bit about InvestNet for a second. InvestNet's a publicly traded company. They provide a technology solution. They don't necessarily hold anything, so they become the technology that creates proposals, aggregates trades, creates reporting, and ties it all together. The accounts are opened, held, custodied, and traded through Pershing, just like any other brokerage account. Okay. The registered investment advisor is TFS Advisory Services, which is a division of TFS Securities. And Portfolio Management Consultants is a subsidiary of InvestNet. They provide us with research, which you'll see on the platform, outsourced CIO, Chief Investment Officer services, because that's not us. We're not that guy. Okay. I'm not, none of these guys are. So rather than try to be something that we're not, we pay them to say, all right, look, we're going to pay an annual fee. We're taking your research, your CIO services. You tell us who's on the platform, who's not, who's good, who's bad, who's in suspense, who's in the doghouse, who's doing well, who's been delisted, who's on the approved list. Okay. Who are we going to provide research coverage for? Okay. Just not our gig. So what the Managed Account Solution Suite provides for us is the ability to craft a full comprehensive asset allocation proposal and actually carry that out within the context of your financial plan, which you're going to see much more as you get involved with training, as you see how it ties in with Pershing and Money Guide and Allbridge and some of the things like that. It is product agnostic, so it's not owned by Fidelity. It's not owned by XYZ. They're not pushing a particular money manager. Portfolio Management Consultants, the research arm, does provide us with portfolio solutions on a turnkey basis to make our life easier. Okay. Pretty much anything that exists out there, you see 40,000 different investment solutions are available. Pretty much every mutual fund, every ETF, any what we call fund strategist portfolio, model, separately managed account. If it makes sense to have, it's available on the platform. If it's not available on the platform, as we've learned over the last 6 years, probably don't want to fight to have it. I just went through a situation with a guy we have in an office in Florida, and he was dealing with a company, City National Bank, City National Rockdale, nice, you know, up to that point manager, but then found that, well, there was this $30 million fine and there was some double dipping on fees. And these are the types of things, you know, other than just the surface, how are you managing money? You know, is your lead portfolio manager there? Did your team leave and go to XYZ and leave us hanging? All those things are what PMC does for us. So you're not going to be limited in terms of the scope of what is provided. The program allows you to build your own portfolios in what we call, we'll talk about it in a second, advisor as portfolio manager. I'll be real blunt, that's not what we're here for, okay? So anybody that has designs on spending a lot of their time being a portfolio manager, realize that it is near impossible to be a wealth manager and dealing with clients and also build portfolios. Doesn't mean that you are an idiot. Doesn't mean that you are just relying on somebody else. What you're going to see throughout the presentation is that we want to accentuate our strong points, our positives, and delegate those things that maybe are weaknesses or just something that there's somebody out there that does it better. Okay. I can't play every position on the field. Okay. That's just my opinion. So what we do is we look towards third-party money managers, hiring the best minds in the industry to manage the money according to the client's investment objective. And it's unrealistic to think that any one of those is going to be the best for every style, for every asset class, okay? This gives you the ability to get the best in breed, okay? Each of the managers or strategies that you pick is its own little individual component or silo. One of the biggest mistakes I saw people make as they were in the business and they transitioned to money management is, you know, they're going to the client saying, all right, well, hey, you know, we've got this new service. We're going to be partners in profitability. We're going to be charging a fee based upon, you know, the assets under management. You win, we win, like Fisher Investments. It's great. And we're going to do all these great things. And they're going to say, well, gee, we thought you were doing that already. Okay. Okay. The difference is, and I think this is an important point, is what Ted did, Donnie did, I did for 30 years, is we dealt with off-the-shelf product. We would find a mutual fund, an ETF, an annuity, whatever. And it's like, you know, buying an off-the-shelf suit. Very nice, looks good. But again, it's not going to fit you the same way, okay? You might be, Bobby might be cut like a V, somebody else might be a fire plug, you know, somebody may be a little taller, somebody may be a little shorter, whatever the situation may be. Off the shelf is off the shelf. Very nice, $400, you get a nice serviceable suit from today's man, and there you go, okay? This is the custom suit. This is the guy comes to your home, comes to your offices, and he takes 40 to 50 different measurements, how long your hands are, how wide your wrists are, you know, what's the measurement from here to the little bone on your wrist, you know, all these little things, inseam and everything, so that you can custom tailor a suit. Okay. So the difference is, you know, your first job out of school, you're going to go to today's man, you're going to go to NBO, if anybody remembers that place, and get a suit because that's what you can afford. But when you know, make it to the bigs, when you're just like our client, when their resources get to a certain point where they need more, they demand more, well, then now they're graduating to the custom suit. And we'll talk more about, you know, how that customization works. But the key point is that by hiring managers and having these independent silos, you are now the third level of management and as a gatekeeper for your client, in that TFS, Investment Portfolio Management Consultants, and now you are deciding, is this management solution that you've provided, whatever it was, makes the most sense for the client? And if it doesn't, you unplug it, you throw it in the garbage, and you plug in something else. When it was just you, who gets fired? You. Okay. So this makes you product agnostic. You now sit on the same side of the table as the client. And we're interviewing, we're doing due diligence, we're making sure these managers are doing their job. And if they don't, we hold them accountable and we put them in a penalty box or we fire them. And the reporting that supports that is all available and very easy to see how managers are stepping up. You'll see a little bit later on, you remember when we get to it, is one of the biggest mistakes is I go to the ice cream counter and sorry, well, look, you know what, I'm at the store, and then you open up the freezer thing, and there's Breyers vanilla and there's Turkey Hill vanilla. You get both vanillas, okay? One of them is going to be good, one of them is going to be bad, or not as good. You're guaranteed that the user, your client, your spouse, whatever, is going to be pissed off because one was better than the other, so you were wrong half the time. If I pick ABC growth or XYZ growth, one of them is going to do better. Okay. If I put them next to each other, I don't really need two flavors. Let me find the best one according to the research, put that one in. And if it requires a change, let me make the change. If I put two of the same next to each other, there's always going to be a level of disappointment. Okay. So we're going to talk about how to diversify properly and sensibly. Any questions on that? Again, I don't want to get too far in the weeds. Envestnet, New York Stock Exchange, publicly traded company, huge firm. The numbers change very, very rapidly. But some of the things that you'll see here, 105,000 advisors on their platform, over 1 billion transactions are done a year. 47 of the largest wealth management and brokerage firms use them. Right now, they're approaching 5 trillion in assets, 15 million investor accounts, 500 of the largest RIA firms out there, trillions of dollars of assets aggregated. So, no small potatoes. Again, does it matter to you? Yes, because their service and the quality of their technology is important. Does it matter to your client? Much less so. It just matters that you got it figured out. We've got it figured out for you. So they are the number one foundational program and third-party asset manager for the independent business. They're currently, in the last couple of years, in a kind of a movement as they're acquiring different pieces. They recently, within the last 2 years, bought Money Guide, the financial planning software that we use, and the depth of the integration allows that to work much more seamlessly together. They're much more looking into the full holistic financial health and wellness. Okay, so you're going to see that they're now involved in other things. There's an annuity side of the platform. They're into credit and lending and other additional benefits that are all tied to wealth management and the client's financial wealth. Okay. Just to make a long story short, you'll see that they're tied in with, some of the largest banks, brokerage firms, fintech companies, money management concerns, and overall technology. So, again, totally best in breed. Won a bunch of awards. You can look at it from Investment News down to wealthmanagement.com, always top in the industry. And as I was talking about before, how the company has grown from being a cloud-based third-party asset management program to dividing their advisors portfolio manager program to the unified managed account, to adding financial planning, and now again getting into full service exchanges for you as the advisor and your client to take advantage of, things that are going to help you manage your practice, things to allow you to provide additional services to manage your client relationship. Okay. So I talked before about the outsourced CIO support services. It's important to know what your capabilities are. Again, if you're a genius and you want to work 24/7 and you love it, I'm not going to stop you. I would still dissuade you, because again, we're here not because how smart we are or how good we are at picking stocks or ETFs or predicting markets, stuff like that. Even if I happen to be good at it, I know for a certainty that I'm so much better, 1,000 times better at managing my client relationships, being an expert on my client, knowing them, doing the best possible job for them, focusing on wealth management. I can't physically do the right job on wealth management and maintaining my client relationships and being a portfolio manager. That's just me, and that's my strong opinion. It's what I try to espouse to you guys, to save you from making unnecessary mistakes in the interest of vanity. We're all capable. If we put our mind to it, we can all be really, really good at it. There's somebody outside already doing it, Let's be smart. Okay. So there's just a couple slides here that talk about the CIO support and investment consulting services, where they're going to basically take the universe of investments. There's an in-depth research tool, and you're going to be able to do screening based upon that. But it's going to determine whether they allow it on the platform, whether it is approved, or whether it's on their select list. And they put together a select list of different funds, ETFs, SMAs, fund strategist portfolios down the line. And that changes on a daily basis. And the select list reports are updated on a quarterly basis. The research tool, if you've ever had an opportunity to work with Morningstar, you'll see it in a little bit. It follows that Morningstar look, okay, and it the same level of filtering that you can filter an investment by name, by market cap, by whatever it is, and you can keep filtering and say, let me take it from 40,000 down to 1. Okay, we'll demonstrate that a little bit more. Okay. So the big thing is the research and the due diligence for us, allowing us to offload a lot of the heavy lifting for the fiduciary requirements that we must meet. Okay. The open architecture in that not being beholden to, pretty much any other management firm out there is either what they call a TAMP, a third-party asset management platform that has gotten into the management game, or a manager that's gotten into the platform game as a way to gather assets. These guys are product agnostic. It doesn't matter who you are, it's available on there. And you'll see that as you get down to it, updated the slide, there's probably about 40,000 different choices. Okay. We talked before about the research status. And let me just move this thing out of the way so I can read it. So you'll see available, 10,500 mutual fund, 750 fund strategists, 600 ETFs, 865 SMAs. Out of that, it starts to shrink down. The approved strategists now 250 SMAs, 2,300 mutual funds, 100 ETFs, 450 fund strategists. Who's approved by portfolio management consultants, PMC, 50 SMAs, 120 mutual funds, and then the approved with analyst coverage. Okay, and then ultimately the select list of 35 SMAs, 60 mutual funds. And that's something that they're going to, as I said, update on a quarterly basis. Okay, each of the covered strategists has a nice collateral material report, research report that you can provide to your clients as needed on whoever the money manager is. Okay. You'll see the research center. These are the research center reports that you would generate on everything that's on the platform. So you'll see that it has that Morningstar look to the report. Okay. And TFS has been working with InvestNet, give or take, since about 2017. We currently have 750 million in assets on the books, 3,000 accounts, 2,000, 2,100 clients, about 65 new accounts a month, 90 advisors using the program, and the management is split about 50% in the unified managed account, 200 million approximately in the fund strategist, and about 175 in the advisor's portfolio manager. SMA are separately managed accounts. Those are just single standalone, separately managed account, one strategist accounts. Okay. We're trailing at about 150 million in new assets a month, or excuse me, a year, trailing 12. And the average advisor fee from all size accounts from 0 to 25 million is about 87 basis points, what the advisor is actually putting towards the commission grid. Again, why do we do this? Again, it's product agnostic. We control and administer the program, not a disinterested third party. Okay. Fiduciary standard, regardless of what master, whether it's the SEC, the Department of Labor, whoever else is going to come down the line, this puts you in a position to stay in full compliance with the fiduciary standard. Okay. Get ahead of the marketplace, the scalability, the open architecture. It allows you, again, with remembering the idea of transferring the things that you don't do as well and delegating. The success of this business is all about delegation. So you can develop a nice sustainable routine, a system, and a process, and also something that you can train to others going down the line. The key thing is you on our behalf are the ultimate owner and control of your clients. Most managed account solutions out there, the advisor, you guys serve as a solicitor on behalf of XYZ investment advisor. Okay, and you have a contract, we have a contract with them that says, all right, they're going to pay you, but they're the investment advisor. You have no control. You don't own those assets. You decided to sell your book of business. It's not going to be treated the same way because you don't have the same level of ownership and control. Okay. The other thing that we've seen and why we stepped in this direction 5-6 years ago is that the SEC, I didn't say they came down on us, but they basically just said, look, if you're dealing with an outside third-party manager where you don't have custody and you don't have ownership and you don't have control, well, that lack of control puts you in a difficult position from a compliance perspective. So, it's almost like they're mandating, say, look, firms, you gotta, there's a lot of good people out there managing money for you, but you gotta, pull in the reins a bit. Okay. What we've been able to do and what we've seen is that it puts you in a competitive position to have a lower all-in cost as compared to the outside third-party managers. And quite frankly, if structured properly, we've seen situations where advisors are out there selling their clients C-share mutual funds and building portfolios and thinking that's their solution to building a sustainable business of ongoing revenue. We're building custom portfolios, not off the rack, for less all-in cost, including us making 100 basis points on the advisor level. Okay. But it's a fee that is sustainable, that you have a contract with the client. SEC decides, like they almost did 2 years ago, we're going to get away with 12B1 trail commissions. And now that business that you built, guys that have hundreds and hundreds of thousands of dollars of trail commissions, boom. Anybody that had C shares thought they were going to build their business, they didn't go away, but maybe you were getting a 100 basis points a year C share trail. SEC came in and said, hey, you know what, that's not cool anymore. it's not fair to the client. So after year 4, 5, 6, depending on the product, that would go down to 30, 25, 20, 15 basis points. That's a big hit. If you're providing the level of service that you're supposed to be providing to the client, you obviously need that income to be able to be level. And obviously our objective here is that we want to manage relationships, not necessarily transactions. Okay. Not that, I'm a do-gooder, but it just does make a lot of common sense for us to be compensated based upon the successful client relationship we provide, not based upon, tuition payments due. I got to go pick it up a bit, get out there and sell some more. Okay. I'm going to skip through a lot of this stuff. It's good material, but we just don't have the time, and it's not necessity. But again, Bill Krager is the president of InvestNet. They have a whole program called the Essential Advisor. But again, where they're very technology forward. So the Essential Advisor for today and in the future will be one that leverages the best technology to deliver the desired level of personal attention to each client, big or small, as they continue to scale their practices. It's not reasonable to expect that you have 400, 500, 800, 1,000 clients. Some of our contemporaries in the business have that many clients, but in reality, they're not clients. They're transactions. You can't have 800 clients. You can't have 800 relationships that you juggle. It is impossible. So technology, the tools that we utilize, and programs like this allow you to focus your attention on managing those relationships so that you can maximize that, have a reasonable number, but also get the job done because we're leveraging technology. The Essential Advisor suggests, and there's a lot of studies out there that'll tell you that the financial advisor doing their job between financial planning, asset allocation, investment selection, systematic rebalancing, tax management, just generally managing the relationship, keeping the client off the ledge, preventing them from doing something stupid, adds at least 300 basis points. They don't have the keeping them off the ledge and avoiding them from doing something stupid box on there. That is, like priceless in the American Express commercial. Okay. Now is a perfect example of it. Should I buy Bitcoin? Should I move everything into oil? Should I panic sell? Should I panic buy? Should I panic buy a house? All these crazy types of things that people are doing, where as smart as we are, our clients are smart. Our clients have access to tons of information. Finding an investment ain't hard. Finding a good investment ain't hard. If that's your value proposition, find another job. That's over. We're not a conduit to investment products and services. Okay. We're sitting down across the table from people, drinking a cup of coffee, eating crumb cake, finding out what makes them tick, what hurts, what your goals are, what your passions are, where your money is. It's important, but it's not the most important thing. And I always tell the story of my one client. He was back in the day when Money Magazine was the thing in the early 90s. He had the Money Magazine best funds of the week. Like, wow, he had the whole from Yakman to Zweig to everybody. Like, wow, that's really, really great. But he's got non-qualified money, qualified money, and he's taken all of his income at, 57 years old out of his IRA, out of his 401k. Like, genius, great job picking the funds, but you missed the forest of the trees. You missed the financial plan. You missed the value of a wealth manager, in that I could have saved you $20,000 a year in taxes. And what you're going to see throughout this, and a lot of the research that you're going to see that's done for you on investments, is not what you make, it's what you keep. So yes, this could be a great investment, but it could be very tax unfriendly. Okay, where another one could be very tax friendly or more tax appropriate. Or it's just a matter of, again, not shooting yourself in the foot. You want to buy a car, I need $50,000. I'm going to buy a new Lincoln. I want to take it out of my 401k. Maybe there's another way. Okay. Maybe there's a 401k loan. Okay. Maybe there's the ability to leverage your investment account and borrow against it temporarily, put it back and avoid fees and tax consequences. Thus the value of the money manager. I don't think we need to go any deeper into that. So there's a lot more stuff here. I'm going to skip through this just in the essence of time. It's good. We can talk about it at another time as needed. It's nice content. But it all really basically just hammers home the keys that I've been talking about all day, and that's the value of planning, the value of wealth management, and the intangible value beyond the fee that we provide. Okay, why clients fire their advisors. Okay, not returning phone calls in a timely manner, not providing me with good ideas and advice, not being proactive in contacting me, not returning emails in a timely manner, underperforming compared to the market. So it's not just underperforming compared to what I think, underperforming compared to the market. The first thing that we do is we disconnect ourselves from the market. We don't compete against the market. We compete against the goals of the client, the benchmark that the client sets, that we set collectively for the client. I looked at my statement and the Dow and the S&P did blah, 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 and I only did X. That's usually when the market's up. Okay, well, the Dow, the S&P, the NASDAQ are 100% invested in the stock market. The NASDAQ obviously much more aggressively. You said your risk tolerance was a 4 on a scale of 0 to 10. Did you want to have 100% of your money in the stock? Oh, absolutely not. Okay, let's come back down to a realistic expectation. Okay, and that's really the word. It's not a benchmark. It's meeting the client's expectation and their needs. Their goal is the benchmark, not the market. So that's why performance is not really the most important thing. It's important that we do the best possible job and that we make sure that we fire somebody that's not. But we want to fire the manager that's underperforming. We don't want to fire the advisor because we're the advisor. So again, a lot of this is self-evident, so I'm not going to beat a dead horse. So after this, I want to dive in and actually do some demo, but let's talk about the types of programs that are out there. I start with the advisor as portfolio manager. Full open architecture. You are the guy that makes the decisions as to what that portfolio is going to look like, what fund, what stock, what ETF, whatever it is, you build it. Sometimes that makes sense, but it rarely, in my world, makes sense for me as the plan that I'm going to recommend. Where I use advisor as portfolio manager is when I have legacy assets that I'm taking over from somebody else that just are, at least at the moment, seemingly immovable. Oh yeah, my dad left me this Exxon stock and told me I could never sell it. Okay. We will have the conversation with the client to say, look, we understand that, but again, what behind all that, Dad wanted you to keep the Exxon stock because he wanted you to make money and he thought it was a good investment. And the objective is stay with a good investment. Don't piss it away and buy a Corvette. Okay. Not don't ever sell Exxon or don't ever sell, the worst thing that people do is they leave their kids houses and tell them that they can't sell them. It's an anchor. Okay. So let's try to cut through the nonsense and find the real objective here. But hey, if you can't, if you won't, if it's $250,000 with Exxon stock and the basis is $1,000 and you don't want to sell it. Well, that's where I use advisor as portfolio manager. Where I take in a portfolio where there are a lot of built-in capital gains and I'll divide it into the tax friendly and the tax unfriendly, and the stuff that tax unfriendly, for the time being, I'll keep an advisor as portfolio manager account and work towards eventually moving that into our program. There's two types of program: gold, which is all-inclusive pricing, unlimited trading. Okay, so for somebody that's actually managing a portfolio, that's what you want to do. A little bit more money in the program fee. Silver is going to be for situations where there's not going to be a lot of activity, so you're just paying actual trading costs. Okay. Ultimately, there still is a discretionary and non-discretionary, but we're getting away from the non-discretionary part of it because it's just a physical impossibility to expect that every advisor is going to call their client on every single trade. The whole thing about money management, fiduciary, investment advisory is that these are discretionary relationships. You're hiring TFS through you guys to manage this portfolio. And, you know, I'm not calling to ask your opinion or your permission. When I set up a unified managed account, I might have 100 investments in there. Every time they make a change, not making a phone call. Okay. Leave it from there. Any questions on that? So again, if you choose advisors portfolio manager, you are a portfolio manager and you need to act as you are a portfolio manager, which is the real difficult thing. If you're going to do it yourself, you must initiate and execute all trading. There's no automatic rebalancing. You will rebalance on your own. Rebalancing technology is there. You just have to initiate it because you're the advisor. We can't tell you what to do. You say, I'm going to do it monthly, quarterly, conditionally, weekly, daily, hourly. Easy enough, press the button. But, you know, there's the first out of a million reasons why you don't want to do it. Is rebalancing good or bad? Anybody? Anyone? Good? Why is it good?
To keep within the model portfolio that you discussed with the client.
Absolutely. Kind of builds in, buy low, sell high. Something got overvalued, you make that less. Something got undervalued, you buy more. Oh, you know what? What happens when you rebalance? Trades. Realizing gains, realizing losses. Okay. Realizing gains and losses intentionally is a good thing. Generally, artificially, not always the best thing. So, not saying it's good or bad. It just needs, like anything else, needs to be used judiciously, and automatic, maybe not always the best thing. Okay. That's, like I said, that's one of H&R Block's 10 million reasons why you don't want to be advisor's portfolio manager. You must, you know, build a model, follow the model needs to be built towards a risk profile. A lot of people are using it as, you know, hey, 20 years ago, I used to put together a portfolio of mutual funds and sell it to my client. I want to keep doing that. This is not about, you know, buy and hold, sit there, get a fee instead of a commission. Okay. It needs to fit a discipline. It needs to fit a risk profile. And the key point here is you must have a definable objective and a saleable discipline. So I have people saying or doing, hey, you know what, I really like advisors portfolio manager. I build, I think I'm really good at it. I build my own portfolios and everything. Sorry, go. Tell me what it is. Explain to me what your discipline is. What am I buying? If I'm buying the XYZ growth fund, there's going to be a little paragraph that says, we aim to do this, we strive to do this, our objective is here, we only have market cap of this, and they tell you the story. What's your gig? Most times it's crickets. Okay. They don't have a saleable discipline. And if you don't, number two, reason why maybe you want to offload to somebody else. Okay. Why outsource? Okay. That way you get to have a definable investment objective and discipline. Okay. What is your selection? If you're looking to be advisor's portfolio manager, what is your selection process, your due diligence process? How did you compare alternatives? What alternatives? How many? How did you arrive at your selections? Can you, and again, can you provide that verbal synopsis of the unique benefits that separate you as a money manager? And most importantly, how much time are you spending on it? Okay. Where I live in the managed account world is here. Okay. Fund strategist portfolios basically are models, portfolios of mutual funds and ETFs primarily that are built around a risk profile. So for instance, TFS buy hold plus models, they're our proprietary home office models. We have 5 models that are based upon conservative, moderately aggressive, and aggressive. Okay, they're diversified models that are built to those risk profiles. Okay, Vanguard, Brinker, BlackRock, Russell, Fidelity, all Franklin Templeton, all have similar, maybe their objective, their selection process is off slightly, but again, they're all an asset allocation that's built off of pretty much the same market, capital market assumptions that everybody else is looking at. Okay, so it's going to be how much is stocks, how much is bonds, how much is international, based upon that risk profile. So you're going to see some nuanced differences. Okay, but again, everybody's dealing with the same information. You shouldn't expect tremendous differences. Okay. This is a great place to start if you've never done anything at all, and certainly never done anything with managed accounts. When we got started in the business 30 years ago, we sold one family mutual funds, and because it was tough enough to learn and tough enough to communicate to get people to, want to invest their money not in the bank. This is perfect because this gives you a way to provide simple, turnkey, professionally managed solutions. Some are actively managed, some are passively managed, some are active passive. Okay. Very simple, nice and easy. And this is kind of the solution for the client that's between 50 and $500,000, give or take. Again, it's not a black and white line. Okay, it's a sliding, depending on the situation, depending on the client, sort of guideline. Generally speaking, my opinion, again, just my opinion, is because of some of the hard costs built in, under $50,000 is probably not the most conducive for a managed account. It's get there, build to that point, but starting out, with more directly owned mutual funds. Okay. So that's the fund strategist portfolio. So these are diversified, could be single manager, multi-manager, but based upon that risk profile, that risk tolerance. Separately managed account. Okay. You guys just took your test. You know what a separately managed account is. You don't have to. You're supposed to have blocked all that out by mutual fund. I'm buying a portfolio that might have been started 70 years ago and built over time. And I may have in there things that were bought 70 years ago that have huge, built-in capital gains and goods and bads and mistakes and winners and losers that are part of this legacy portfolio. Okay. Mutual funds are the greatest thing in the world. It was an adaptation of the separately managed account. 100 years ago, you hired a professional money manager to diversify and manage your money professionally, but you needed millions to hire that manager. The mutual fund was scale before they used the word scale as something other than to waste something. It gave you scale that the little guy can put their money together with other little guys, become one big guy, and hire that money manager. Okay. And then they became off-the-shelf products. Sorry, look, we have this fund, this objective for the everyman or the small subset of the everyman. And it's the greatest thing that ever happened to the investment business. Okay. But again, it's off the shelf. Here, a separately managed account, much more custom. And it may not necessarily be the full custom suit, that particular separately managed account, but it's custom to their objective. So where the fund strategist portfolio is a portfolio that is risk tolerance profile based, the separately managed account is based upon a very specific objective. Where the mid-cap growth Vietnam fund, such a thing even exists. That's all we do. Okay. We're a low correlation, high beta, crisp, large cap equity fund. Okay, great. Okay. But the big reason why we like separately managed accounts is because I'm buying not what the manager thought was good 70, 60, 50, 40, 30, 20 years ago. What's good today? Well, if I'm going to build a portfolio today, I know what the portfolio was 2 weeks ago. I'm the money manager. I've made those decisions and I made some mistakes too. Going forward, would I build a portfolio the same way? No, I'm not going to make that same mistake. So I'm going to build a portfolio, today's portfolio, and manage it from today forward. No legacy issues. The big thing is, from a tax perspective, you have beneficial ownership of the underlying security. So there's no legacy tax issues, no phantom taxes where I own a mutual fund and to meet down market redemptions, they're redeeming stuff. And, the fund might have been down 20% and I'm paying 20% capital gain distribution. That sucks. Okay. So here I own the underlying investments myself. And that allows me to give guidance to the manager to be able to do tax loss harvesting and things like that. Same concept as a mutual fund, just not nearly as custom. Could certainly be, there's many very specialized mutual funds, but from the beneficial ownership and the flexibility and the fact of being able to buy what's good today to build today's portfolio. Bless you. That's the key. Separately managed accounts, 10 million, 5 million, 2 million, million. Now they're down, many of them under $500,000, many of them under 100. We have some that are $40,000 to $60,000 minimums for a separately managed account. That's amazing. So what it allows us to do is to build portfolios utilizing different sleeves of separately managed accounts. The unified managed account is basically just a flexible, unified managed account. It's a big shopping bag that I can put a bunch of stuff in. So I could put mutual funds, put SMAs, FSPs, ETFs. Just it's a big hodgepodge, which means why wouldn't I open all of my clients in a unified managed account? Great question. Donnie does. That's what I do. When I don't, it's because it's too small. It's $100,000 minimum for the account. If it's 50 or 75,000, I don't need more than one manager. I don't want more than one manager. Pick a manager, put it in a fund strategist portfolio. If I know that, hey, this is only going to be 75 for a couple of months, they're going to be adding money to it. Let us know. We can, get an exception, get the account open as a UMA, because it's ultimately going to be, over 100,000. We can do that. Bob.
I'm sorry to interrupt, but UMAs, are there some SMAs that are not permitted within a UMA?
That's the next part. Thank you for.
Okay.
No, certain money managers that manage separately managed accounts say, we don't want to be mixed in with somebody else, even though the reporting is very clear. This is what this manager does, what this manager does. We're not going to do it. And I have some of them, some of my bigger clients, I have different accounts, because they're higher minimum specialty manager. They just don't want to be mixed in with other managers' stuff. So the unified managed account is, again, you're going to build a portfolio. It's all always tied to your client's risk, but you can adjust that. You might have something very aggressive and something very conservative. It's not based upon the risk profile of the individual underlying piece, but it's of the combined package. So when we put together our proposals, you'll see we're going to be looking at the blended expectation of volatility and the risk profile for the entire portfolio, not each piece. Okay. We call it the advisor-driven UMA because we have the ability, and I think those of us who've been doing it for 5 years now have the capabilities, and we know there's a handful of money managers that we're comfortable with, and we're going to build a UMA utilizing those money managers. But generally, that's for my range somewhere between 100,000 and depending on the client, between $500,000 and $1 million. Once I get over $1 million, I'm looking to take another step. We have two things, and I'm gonna do them in reverse. There is what started as the private label unified managed account. So Envestnet PMC put together a series of private label unified managed accounts where they provided the entire model. They picked the managers, they created the solutions. I'll show it to you in a little bit. We needed to do nothing, completely turnkey, completely risk-based. They provided the models that you could implement, but you didn't necessarily have to follow them. So we are the discretionary manager in that particular case. So if they came out and said, gee, you know what, we had XYZ managing the large cap growth, and now we are suggesting that we move that to ABC, you don't have to change it. That's their recommendation. So they'll provide quarterly guidance on that. I think that's a great thing for the person that fancies themselves as the advisor to the portfolio manager. Still not me, okay? But that's for a minute, that's all they had. And what they found out very quickly is most people don't want that. They want, hey, could you just tell me what to do, please? Just give it to me. And that's the strategist UMA. So they have a single manager, single strategist tailored to a specific theme or objective, whether it's income, decumulation, impact, tax efficiency, whatever. Very limited flexibility because now they're managing the model. You're not saying, I don't really want it this way. So if you want to tweak it, you go to the top one. You want to let them do the job that you're paying them for. That's the bottom one. $250,000 minimum with unlimited range and much more aggressive pricing the larger that they get. And I'm going to show that to you in just a couple of minutes. The key things, and you'll see it as you start making more proposals and doing more proposals, is that every proposal you do creates its own model to be followed by the trading and execution. Okay. Consequently, if you're doing a lot of the same things, or let me look at this way. If you have 200 clients and you have 200 different proposals, you have 200 different clients' proposals to manage. If you're doing a lot of the same stuff for a lot of the same clients, say, look, my conservative clients get this, my moderately conservative clients get this, my moderate clients get this. You create models. You can manage one model for many clients rather than one proposal for one client. So you want to try wherever possible to build those models. Again, not that you're being the manager, but just to say, look, you know what, if I'm putting together 3 fund strategist portfolios or 4 SMAs, 1 fund strategist, and I like the way this is working, to me, that's being as much of a money manager as I need to be. Okay, but if I'm using it, and rather than having to redo it every single time, let me just pick up the, the Rob 250,000 conservative model. Drop that as a proposal and move on. Because then if I need to make changes, I don't have to go to every client. I just go into the model and change that model and say, take out XYZ, plug in ABC, everything happens. You don't need to do anything. The other thing, a lot of mistakes that people make is not understanding why managed accounts differ. Okay. I see a lot of people chasing their tails, firing managers because they didn't meet their expectations. The problem was their expectations were based upon not understanding the fact that, they might have been a tactical manager in a time where they just were out of favor. Okay. So a traditional asset allocation that's going to be, providing broad diversification among asset classes, tactical overweighting in certain areas, perhaps heavily in some, falling short of timing, okay, but more overweighting and dynamic being very tactical, perhaps timing, perhaps momentum based, okay, and maybe shifting between styles. It's very important to know what the underlying money manager is going to do. And then within each of those, be able to at least have an intelligent conversation. Is it an active versus a passive manager? Is it somebody that's top down versus bottom up? Are they looking at technicals or fundamentals? Is it growth or value, large cap or small cap? Is it rate driven? Is it contrarian? Is it dividend driven? Is it qualitative research or quantitative research? Not super high end, high finance stuff, but stuff you just need to know so that you're not giving the client 3 brands of vanilla ice cream when one would be fine. Okay. I'm going to do this one last thing and maybe just jump in and demonstrate. So the great thing about it is the InvestNet system has something called the digital portfolio consultant, and that basically allows us to not have to think. It provides a mechanism, a screening tool to be able to find both fund strategists and UMAs that fit our clients' objectives. So it's probably not a bad time to maybe take a break, answer any questions that you may have, and it will shift over and maybe dive into doing a proposal live. Is that okay? Questions? Don't be shy. You guys?
You guys definitely have some questions. There's no doubt. So don't be shy.
Well, Tom, I recall from a webinar a while ago, you were talking about, or I think you were showing us the actual practical, the way to actually produce your own models that you were just describing on InvestNet. So let's say you have a conservative model, hypothetically, and it's a sleeve of like 3 different asset managers. And then, you just got 10 people in it in the last 6 months. And all of a sudden, one of those 3 are just, nobody likes them, including yourself. Is that, I guess I'm just trying to, in my head, figure out, is that like the only downside to that strategy of like, because then you have to go to each and every person and explain, look, I put you in a.
If you were doing it as a advisor, as portfolio manager, yes, it is discretionary. So you have the ability to change. The only thing that would if it changed would be if whatever change you made to the model changed their risk profile. So if they said I'm moderate and you decided to change their model, remove fund A and put in fund B, and all of a sudden that now became moderately aggressive. Well, you either need to say, well, gee, that wasn't really a good replacement. I need to find a replacement, or I need to tweak my allocation so I'm back to moderate. Or if you say, which happens far too often than it should in reality, is somebody saying, well, that's what my client wants. Well, then that requires what's called a goal modification. You need to have them sign a new statement of investment selection, investment policy statement that says, I'm no longer this, I'm this.
That's not, let's say you're in a UMA, not in a,
Either way.
either way.
Yeah, and anytime you're doing something to the client's portfolio that's going to take them out of their selected risk profile, you need to get them basically to sign off saying, yeah, I know I said I was conservative, but now I'm aggressive. You know, when the market goes down, you know, there's exceptions that can be done where people say, well, gee, you know what, I want to take some money off the table temporarily where they protect cash. But a lot of times it's like, you know, you can't be aggressive in a good market and conservative in a down market and bounce all over the place. And if you are, you're going to need to get the client to sign to justify, because a lot of times it's not the client, it's the advisor. You know, if you took 30 seconds to talk them off the ledge, you might not have that problem.
And if it stays within the same risk tolerance, there is no paperwork needed. You can
Correct.
just- okay.
Right, because it's a discretionary relationship. All right, well, let's not assume that anybody knows anything. So what I did was I logged into Pershing's Net Exchange 360. That is our front end. Basically everything we do through Pershing is in there, and they have a single sign-on connection right to the InvestNet asset allocation program. There we go. You guys can still see that? Yeah. So this is your home screen. I think we can bounce around and show you all the other stuff later as time permits. I want to kind of just jump in and do a proposal for you. Okay. But, you know, you're going to see there's navigational on the top, practice, clients, managing models, the research, and notes about the platform, all good stuff. And then down along the left, again, you'll see the practice, service request, proposals, etc. Okay. When in doubt, little house here is the home screen. Okay. And the easiest thing to do when you want, you can go in and just create a new proposal. Okay. So all the stuff is on the homepage. Now, I don't know, has anybody used the new proposal? Teddy? Okay, I've only done it once, so I'm going to try to limp through that. Is that okay?
Yeah.
There's a new user experience out there.
So when we create this proposal, we're assuming that you've created risk models already, or there's pre-selected risk models that you're going to use based on the risk
Yes.
tolerance.
Yep. Yeah, you don't need, you'll see it in a minute. So the models that we're making are really more for administrative simplicity than actually building portfolios.
Yeah.
It's hard to understand, but you'll see it in a minute. Okay. And what this presupposes that we sat with a client, we have filled out a questionnaire, so we know, you know, based upon what they've told us, what we can glean from the information, and perhaps what they've signed their name to, or maybe they're sitting in front of us, which I've done a bunch of times now. Just go on the fly. So I click create a proposal. And bear with me, because again, this is only the second time I've done this particular version. All right, so I can create a new household, or I can search an existing household. Not sure. So now I started typing the client's name. So if I have a client in there that I've already done something with, I can just type in the first few letters, and there it is. Test family.
They're only clients that you've done business with as well.
Anybody I've ever done at least a proposal on investment for. Okay. And hopefully this test family is still in good shape. It's what I used in training before. Okay. If I want, I can go in there and edit it. I can change the name. Who are they? Who are the members? I have John and Mary Test. Okay. I can fix that. and I can customize and say retirement asset allocation proposal. You can call it peanut butter and jelly, doesn't make any difference. Okay. Risk tolerance, you can take the risk questionnaire or now use their tool, this risk tolerance tool, to assess the client's risk tolerance. Okay. It's actually much simpler. How much do I plan to invest? 250,000. How many years am I going to keep this money invested? 25. My risk range is I'm going to be 58, 71. Yeah. So I'm kind of on the moderate to moderate aggressive side.
I'm sorry to interrupt, but I need to say this. I haven't used this yet. It's designed to be used in front of the client.
You could, I
Is
mean,
that what it is designed for?
I would say, let's take a look at it and determine where you might say, oh, gee, I wouldn't do this for the client. It's much more designed for that. Yeah. You know, because you can tweak it.
I did one and I wound up using I just did a Brinker destinations model with it. The client was like super conservative.
Mhm.
Just a feedback on Ted's statement. Are you finding out they're conservative just for conversation, or are you still doing the old school risk tolerance questionnaire?
I did the old school risk tolerance and then I plugged it in.
Okay.
And this is a little bit more straightforward than all those questions. You know, your portfolio was down 20%, and A, sell half, buy more. I like this a little more straightforward.
Most
There's
of,
more interface with net Pershing on this too, kind of.
yeah,
It goes back in the NetX.
right. Most of what I've done, just different station in my career, is I'm telling the clients what their risk tolerance is. You know, but you know, open for collaboration based upon my experience, based upon our conversations, 20 years, da da da. You know, I have you, you know, as a 6.5 out of 10. Yeah, that's probably right. And because I educate them about, you know, what is their risk tolerance going to be in good and bad times. You know, you can't be all over the place. But again, it's saying, rather than just give them the questionnaire, most times I walk them through the questionnaire, because all of these questionnaires, like anything, all drive everybody right to the middle. You know, well, you know, if the market went down 100 grand, I know I'm supposed to hold or buy more, but I'm not sure. And everybody pick the middle, and then they get moderate. Okay, so this, it's not as there's less questions to ask, but there's also less of asking the same question 3 different ways. So I like this.
You guys want me to turn the lights off a little bit? Is there a big glare for you guys? Everybody okay? Yeah.
I then get to select what the investment objective is, whether it's growth, income, or preservation of capital. Obviously, based upon my more aggressive risk profile, preservation would be inconsistent. So. And now you get to determine whether your proposal is going to be for an actual investment account, like everything we talked about, or even an annuity. We haven't talked about the annuities yet because it's still a newish thing to them. But again, being able to provide the discretionary account management and asset allocation services within a variable annuity contract, or even an index annuity contract. So for now, just to stay on Main Street. Okay. Go with the same 250, and we're gonna do an IRA rollover. There we go. Owners John and Mary Test, purchasing custodian already. Specify funding sources. This is nice because again, there's a lot of other information that you're going to be asked for down the line. This gets you to, if we're taking it out of some other investment, there's going to need to be some, what's the word? Not justification, criteria, reason for the change. Okay. So, it's an account that's already on platform, or, there are no investment accounts. I can select and add to it. I'm just gonna say as an account that's on the platform already. You can select tax or impact overlay services, tax being, tax harvesting, tax management. There's an extra 10 basis point charge for that. Impact overlay, again, not much call for that in my clientele, but perhaps in your clientele, people's values, are a little different. So impact being ESG, social responsibility, corporate governance, environmental, things like that. So I then I can select an existing strategy. So to Bobby's point, I have give me an existing advisor's portfolio manager or an existing TFS unified managed account. I probably have some models in there. I'm not going to use this, just to demonstrate. And here you go. So here's what's available in existing strategies. Okay. So this little growth model is something that I made goofing around. Okay. BlackRock target allocation with SMAs is one of the available strategist UMA programs. EFS is InvestNet Financial Services. That is their the private label UMA models that are available. Okay. And even this growth FSP UMA model 100,000 plus is one that I made myself. So to Bobby's point, if I select that, and every client that I have that's in that growth over 100,000, but maybe not over 250, that's in this spot, I can now manage this model rather than go into every single client and make the same change 100 times. Okay. I'm going to go back and I'm going to change that. And what I don't have change. What I'm struggling with is to go back one more screen and get out of select the model and go back to digital portfolio consultant. So, jump back into it. Back to this again. There we go. So you discard it. My advice to you is, you know nothing, use digital portfolio consultant. I was going to ask you a couple of other questions to narrow it down and say, all right, what am I looking for? I'm looking for traditional asset allocation and risk mitigation. I don't need to be tax sensitive because it's an IRA rollover. And I can select only from PMC approved list or everything. So for now, I'm just going to say everything. I always go back and change it. And it's going to give me 115 results. well, I'm new. I don't want to deal with 115 results. Let me go back and say, what about just PMC approved? Now I'm down to 66. Okay, maybe I want to go back in and say, how about cost sensitivity? I think I did it. Still 66. Everything's cheap. Yep. But you get the idea. So out of 66, I can look at this and over time, I'm going to be able to know just from experience what I'm comfortable with, what I'm used to, everything else. The nice thing here, you're going to see what the risk class is, what the minimum is, what the total product cost, basically, other than your fee, and what type of program. Mutual fund and ETF wrap, TFS unified managed account, and again, you can roll over it and you can skip through, and it's all alphabetical. And you'll see mostly fund strategist portfolios, some unified managed accounts. The bigger the account size, the bigger your proposal, the more available unified managed accounts will show up. Okay.
Tom, you said you don't typically put someone in any of these unless it's 50K or above in investment. So a lot of these are as low as
If somebody said, look, I've got $5 million with you and my kid has $18,000 in a, custodial account, and I demand that you do this. I don't have any of those situations, by the way. I'd probably do that. But otherwise, new client coming in, looking at it and saying, gee, you know what? You're in the early stage of life accumulation phase, less than 50 grand to open up an account. Again, if it's close and we're going to be saying, hey, look, we're putting $1,000 a month, $2,000 a month in, fine, no problem. But, otherwise I'll start them off, with an individual fund. So going through this list here, I'll just pick because it's, where was that there? I'm going to pick this BlackRock target allocation with SMAs. It's a unified managed account. Cost is reasonable. It's spinning now. You want to find out some more about it over here on the right. Little quick facts, product description, overview, a lot of little drill down spots to view more. Return history is actually very nice to have this over here. And if you want, you can click the full product analysis. And scroll down there. All right, so we've selected that. Save and continue. So you can see the risk tolerance, you can see the proposed asset allocation, both at the high level between equities, income, and cash, and then by investment objective. And then preview, okay? So you skip the steps, proposal document will be generated as part of the final documents package. So I don't skip it. Would you like to generate the proposal? And what this allows you to do, which I did early on, stopped doing it completely, is messing around with tweaking the investment proposal. Some really cool stuff in here. So what I'm going to do, and I'll actually email it to you guys so you can see it, you can create different templates. So this is template current default. You can have an intelligent investing template. You can have a, whatever, and you can save your own. So you can say like big client, middle client, small client, gold, silver, bronze, rocket scientist, simpleton, you know, you can adjust your proposal output, because when you give them 127 pages, 27 pages, 7 pages, you're probably going to be looking at the same 7. The rest of it is very impressive sales tonnage, which you may or may not choose to use, but it's pretty cool stuff. So you got all this stuff in here about intelligent investing, and you can go through and select the whole intelligent investing piece or individual, active, active passive, low cost, factor based, income investing, sustainable investing. I mean, it's quite an educational process, but you know what? What we've always done, and the education has varied over the years, is that you educate conceptually so that everything you do after that is just kind of, it's a foregone conclusion. By the time I get through with my presentation, the client is like, so what? I guess we gotta like give you a check and sign some forms. There's no, what do you think? Or, you know, in order to get started, I'm gonna need, yeah, once in a while, but most times we've invested a lot of time at the opening, behind the scenes, putting it together. When they see the proposal, it might be like, you know what? I know we said it was 250, but something happened and we needed a new hot water. It's only 240. Okay. Go in, tweak, change it. It's 240 now. And then continue on. But most times clients are not accustomed to the level of time and energy and expertise and education. You know, the education that we provide takes the anxiety away, it makes the decision-making that much easier. So I'm not suggesting that we check every box and bombard them, especially with stuff that's not germane. But I'm going to show you that this is going to be about 250 pages, and it's probably cool. Forward projections, does Monte Carlo simulation, great concept. Challenge you to try to explain it intelligently to your client. But this will be a good takeaway for your own review and training. All right. So we've customized proposal, generate the proposal. So this is in draft mode, which is good because you can still change it. There we go. Sum it up. Yeah. So you'll see the draft watermark. You obviously can't show anything to a client that says draft on it, and it's only 71 pages. Not bad. Quickly go through it again. You can look at this on your own time. We can explain it more. But table of contents. This is all the intelligent investing stuff, the power of long-term investing, why be in the market, or the key is to be, it's time in the market, not time in the market. Okay. Importance of diversification, called the jelly bean chart or the periodic table, just showing that, you know, there's a lot of different disciplines in investing. It could be pick what was good last year, pick what was bad last year, pick a little bit of everything. Okay. Ultimately, over the long term, the best thing that's been most consistent is diversification, modern portfolio theory. Importance of diversification, a lost decade. Capital markets have favored consistent participation. Again, it's that time in the market thing. If you lost, you know, how many days that you were out of the market, how much opportunity you would have lost. Staying the course. What does risk mean to your portfolio? The importance of rebalancing. Life cycle of portfolio management. benefits of active management, benefits of active passive, meaning, yeah, active sounds like it would always be better than passive because it just sounds like you're doing something versus not doing something. But if active managers have not been able to, beat the large cap indexes, why not just buy the S&P 500 for 2 basis points and call it a day? And just give me the S&P. Don't try to beat it because you never do. Just give it to me. It's cheaper. I'll gain by saving expense. Whereas if I'm going to invest in emerging markets debt, well, that's a highly specialized area where a manager has proven to say, look, that manager might be able to add 400 or 500 basis points over and above that benchmark. That's where active makes sense. Active passive says, let me use active where active makes sense, passive where passive makes sense. Which market conditions for active or passive, which is great. Benefits of low cost investing, factor-based investing, which is all the rage. What you're going to see a lot now is both with the investment PMC, they have direct indexing portfolios. So, whereas instead of buying a passive index portfolio, that you're actually buying a direct index portfolio, that is, again, the actual underlying securities with some degree of management poetic license where they can, overweight, underweight slightly. Okay. Factor-based investing, using that direct indexing and looking at the value, quality, momentum as additional factors to kind of tweak the asset allocation. Okay. Size, value, momentum, volatility, quality, liquidity, the different characteristics that they each have, unique sources of income. I mean, again, there's a ton of good stuff here. Current yield and the downside risk that comes with it, impact investing, ESG integration, what are alternative investments, hedge fund strategy correlations, types of tax minimization, all of that. So there's 27 pages of, I'll call, nice foundational investment education that ain't happening anywhere because people just aren't going to take the time. They're going to go through, they're going to fill out a questionnaire, say, you're moderate, here's the moderate piece, good luck with it, on to the next client. Okay. I found 35 years doing this, even though they may not understand everything as well as I do, giving them the opportunity to get the education and to understand why. When I fill out my clients' confidentials, I'm constantly asking them why. Rob, can you explain to me what was the rationale behind making this decision? What was the motivation? How did you feel? How did you feel after? Were you happy? Were you sad? Were you satisfied? Dissatisfied? What about the experience with the advisor? Tell me, because I'm trying to figure out what makes you tick. All that stuff is important. So educating them gives them credit for their intelligence. And again, the person that benefits the most from that education is me, because the more I spend there, the less I spend here. What's going on? What's happening with the market? I want to buy gold. Susie Orman says I need to buy gold. She's still alive, still in the business. So here's the actual proposal itself, where it kind of takes a logical, top-down progression from the overall asset allocation to an efficient frontier analysis. You'll see here, it's a little rough to see, but the client's risk tolerance is on the growth side. So there's a little gray diamond in the dark section there. And then the efficient frontier. I love the efficient frontier story. I'm a traditional asset allocation guy, modern portfolio theory. It always resonated with me that a client has an acceptable level of risk that they're willing to tolerate. And for that, our job is to get them the best possible result. Okay. So that's why this efficient frontier shows that for that growth portfolio, based upon the parameters that they said, we're we're not actually right on the line. We're off it a little bit. Okay, but we're just below it. That is a highly efficient portfolio because there's other inefficient portfolios that might have the same risk that are providing less return. And I explained to my clients that generally they have one of two inclinations. Either they're going to be very conservative, very aggressive. I'm a risk tolerance based perspective, or I'm a return based. I would be happy just to make 5%. If you're a 5%er, it's okay. Well, my job is to get you to 5% as smoothly as possible with the least amount of volatility. Either way, okay, we're on that efficient frontier. Monte Carlo simulation, I've kind of stopped talking about it because it's just, there's very little upside to the conversation. It's important maybe that they know that we've gone through the process, the millions of iterations to determine what is the likelihood of an outcome. I don't feel comfortable with them walking away that there's some degree of predictability that we're looking at. So, you know, it's a test that we do behind the scenes. I explain a little bit and then I move on before they start pulling me deep into the weeds in someplace I don't want to be. So here's the target asset allocation. If I took the time, I would be able to also put in what they had so we could do a side by side. So if they came in and they had a particular portfolio, I can either import or type in the existing holdings and do a side by side and say, look, you know what? You'll see based upon your risk tolerance and the target asset allocation, yours is all yellow. Okay. And that's international developing markets. That's totally inappropriate. This, especially when we do the side by side, to me, game over, because again, rarely is anything that the client have consistent with the stated portfolio objective and their risk tolerance. Okay. So they're going to look and say, gee, you know what? We went through all this scientific background questionnaires, all this education, all this other stuff. And you're saying my asset allocation should look like this, but mine looks like a negative copy of it. Yeah, we got to make some changes.
Just where would you show that side by side, if you don't mind?
It would just be right next to it. It's just that if you put in the existing holdings, I'll go back because I actually skipped over because I didn't see it. But I know in the old proposal system, you instead of putting in the amount, you could specify holdings. So if you said, hey, I got 5 AT&T, 3 IBM, 2 XYZ, and you'll see it. And it'll give you the asset allocation breakdown as opposed to the specific details of it. And that's super powerful because look, at the end of the day, you know, you go to the shoe store, you know, you're a size 11 triple D and they're trying to fit you in a size 8E, ain't gonna work, you know? And then I'm telling you, 90% of the cases, it's that bad. It's like fat guy in a little coat. So there's a lot of other stuff that admittedly, I don't spend a lot of time on. I don't need to, but you know, you've got the performance scatter charts, you've got the comparative mountain charts, bar graphs, most recent quarter, 1 year, 3 year, 5 year, 7 year, 10 year, year by year returns. Performance of the underlying holdings. So if I had multiple different strategists, I would have it listed here, how each of them have done as compared to their benchmark. Yeah. Current yield. So this portfolio is kicking off a 2% yield. I pointed out to the client because the yield is important because that's 2% of total return that I'm getting that isn't relying upon growth. That's going to be there. Even if the market goes down 20, well, it's only going to be minus 18. That's not bad. So, you know, we want to be thoughtful of, is that yield what they want or what they don't? Maybe in certain cases we don't because it might be generating some tax. But, you know, that's a concern. And then the other thing too is the underlying net expense ratio of all the underlying holdings is only 16 basis points. Okay. I do spend time on that. lot of stuff on the risk statistics on Sharp, alpha, beta, R squared. I just explained to them that obviously through the research, there's a lot of very sophisticated measures that we look at the portfolio level, because one of the biggest mistakes that people make is they look at underlying holdings. We're looking at the portfolio holistically. Good portfolio management, 1 + 1 should equal 3. The synergy, the sum of all the parts should be worth more. That chart, and then breakdown of the equity piece based upon equity allocation, sector, geographic region, country analysis, market cap. Same thing on fixed income. Based upon the maturities, quality, sector. And then we get into a draft of the fee. So the all-in fee with the advisor making 100 basis points is 1.59%. Cheaper than they would pay for a C-share mutual fund that's unmanaged off the rack. More stuff in here about stock market cycles, and it goes on. Interest rates, treasury yield curves, corporate bonds, unemployment and wages, GDP growth. I mean, you could give your client a bachelor's in economics from this thing. And for as many silos, strategists, managers that you select for this, there will be this Morningstar-esque research report that goes through BlackRock target allocation with SMAs, their aggressive growth model, the allocation. You'll see the top 10 holdings. Bless you. Where this is mostly done with ETFs, and then tons of disclosure. So, good, bad, or different. Is it the best out there? I would say it's arguably one of the best. And I think some of the enhancements to the proposal are significantly improvements, but it serves the purpose.
When you're sitting down with a client running through these proposals, is there ever any page in particular, any topic in particular that you spend the majority of the conversation on? Obviously, there's a lot of educational lead up, but then there's the actuals. What are the nuts and bolts of what's in here?
Yep. Yeah, I think that's super. It's a great question. I spent a lot of time, not a lot. I spent a little bit of time on this, explaining that, hey, there's a bunch of different ways that people manage money. Some people predict, some people time, some people look at momentum, some people buy yesterday's winners, some people buy yesterday's losers. I generally don't think I don't think anybody's very good at any of those. I choose to look for diversification. And like if you were baking a cake, I'm going to look to try to find the ideal recipe, the ideal balance of all of these different asset classes, because I don't know when one is going to be better than the other. Certain times that I do, I have the ability to overweight here and there. But again, we're not looking to hit it out of the park. We're looking to meet your objectives. And that generally is, their objective is to meet their objective, not I want to make 30%. So, diversification and asset allocation. I will talk about the goods and bads of rebalancing, which we talked about before. I will explain, as I did before, about active passive and why I use both. So when I do a side-by-side portfolio, I'm going to be able to see before and after. So I'm going to point out at the high-level asset allocation, the differences between what they have and what they should have. Okay, definitely going to focus on where it says asset allocation, the risk tolerance I call it the applause meter. Okay, so are you going to be conservative, moderate, or aggressive? Okay, and I'll have the conversation. Say, look, this is based upon my experience, our conversation. Here's some of the questions, and they'd be like, yeah, that sounds pretty good. Because a lot of times I'm suggesting, I think you're a 7. They might say, oh my God, no, like, all right, let's come to a consensus and then move on. I will definitely talk about efficient frontier. As I said before, I'm just a big believer, and I think it's a concept that the least sophisticated client can understand it. It just makes a ton of common sense to them. I definitely don't talk about that. I will spend time. And again, I think this is where the sale is made, when I have before and after, and say, hey, this is after, you're before, like, wow, you're not even in the neighborhood. We got to fix this. Beyond that, once I get past that, there's not much else. I will glance over these things to show that the homework is done, that the research is there, that the results are excellent and long-term and profitable, and that there is a 10-year track record, and we have the 2% yield, and we have the low expenses.
Keep in mind on the track record part, some of it is, you get kind of handcuffed a little bit. Recently, so it doesn't go back.
Yeah.
So American funds have been around forever, but this model that might be only been around 2 years. So there isn't a 10-year track record and stuff, so you will get a little bit.
The nice thing about being able to do it on screen with somebody too is that if a particular investment solution that you select is made up of other, like there's a SMA that has a fund strategist portfolio, or another SMA or something else, you can drill down and it's all hyperlinked. So that might not have the 10 years, but what's underneath it might. So you can drill down and say, all right, hey, this is what it's made of. Here, see this one? Because a lot of times people say, oh, wow, neat, you have Microsoft. That's cool. Okay. But that's really pretty much it. Like so many things that you're going to find, where I will hit on the data sheets as well. It's more the fact that we did it, we did the homework, and we demonstrated it. Your teacher didn't look at all 40 pages of your book report. But again, that's just being able to read the client and determine if you're starting to go through stuff and you see them nodding off, like, get to the point. If somebody's on the edge of their chair saying, wow, this is amazing, do I get an MBA for this? And give them more. Other questions? So I'm going to save this for now, just in case. Just in case. So now basically we have something that, depending on what you anticipate, will determine what your next step is. I have a guy coming in tomorrow. He already called me and said, yeah, I know I said this, but let's make the number something less. That rarely happens to me, but this is going to be a guy that is going to probably rifle through the money way faster than he should. It's unfortunate, but I sense it already, because he's already spending money he shouldn't be spending, and we haven't even invested it yet. So I did all the work. I'm not changing anything. I'm like, look, yeah, I know you said you're going to change it, but I'm just going to show you what we have, and we can tweak it on the fly. Okay. Because while I could easily continue on, it's okay. You said 250, it's now going to be 190. I'll make 190, and then we get on, and then, hey, we can open up accounts right away. You're going to have paperwork ready for you. But I sense there's going to be another shoe to drop, and you'll see in a second, we don't want to let people think about things too long. We, we're in the sales business. I get all that, but in this particular case, I'm going to get him to a point, this point, and he'll say, let's tweak it, fix it here, boom, we'll continue on, we'll finalize it, and then we'll go on and I'll hand it off to my assistant Lisa, and she'll generate all of the the forms and documents through e-signature and email it to him. Also, you'll appreciate it after you get there more than once, twice, three times. I don't have to sit there and pass papers back and forth, sign here, date there, miss something, forget it. So in this particular case, I'm going to just, I don't know which way this guy's going to go, get it to a point. He will say yes to something. I'd be like, great, no problem. You know what? Keep an eye out for an email from us with an invitation to a e-signature signing ceremony. It'd be real simple. You just go through, click. If you have problems, give us a call, call me, call Lisa. We'll walk you through it, blah, blah, blah. Other times, I know that it's not going to change. There's no reason that it should change. And I'm just going to go ahead and say, okay, I'm going to go from draft and let me save and continue. I don't encourage it, but if for some reason somebody has something that is able to accept investment restrictions, I would be more likely to say, well, that would be more on the ESG side, the impact stuff. But if somebody said, yeah, I want everything but Philip Morris, you put it in there. Okay. If I wanted to set it up where this particular proposal, the market's really high. Clearly it's not, but a year ago, we might have thought, hey, the market's really high. So what we're going to do is we're going to take, I could invest the program minimum up front. I have to meet that. So let's say it was a $500,000 account, I could invest $250 and I could dollar cost the other $250 in over the course of, again, I could do it weekly, monthly, quarterly, semi-annually over whatever period of time until that protected cash is exhausted. Okay. I can protect cash. Let's say I'm going to have money coming into the account, but that's going to be going out quickly. I can protect that so it doesn't get invested. Okay. Set money up pending distribution out. Set security restrictions. I don't have any of that. Okay, if I want, I can go in and if I said, gee, you know what? This is my aunt, which I don't recommend, by the way, because that sends a message that, especially to the regulators, that you're overcharging other people. I would keep your fees consistent. But, if it's all right, instead of charging Auntie 1%, I have here's a 75 basis point flat, 0 advisor fee, 50 basis point fee, flat fee, whatever it is. I can go in and I could change the fee percentages at each level, save it as a template and apply it to any accounts. Okay, which I'm not going to do. We keep the fee the same. Agree to continue. There was also a spot in there about exclusions. So if you're going to have any assets excluded from fee, you can do that. Again, I don't particularly, because I'm taking into my account, I'm taking the responsibility of it. There's an expectation I'm going to be doing something and managing it. So it would have to be a very rare circumstance where I didn't. So what is this? All right, so then we generate documents.
This is where kind of, where like interfaces with NetX a little better.
It's saying, please wait while the proposal is acknowledged.
So in the proposal system,
Oh.
at least the other one, Tom, you have to acknowledge it, otherwise it has draft all over it.
Yeah, all right, so that, yeah, that's, so if I go here. All right, so it's confirm the proposed strategy on the right and generate the draft documents for your advisor to review. Generate that draft documents or edit, or you could generate the final documents to continue with the account opening. So I acknowledge. Then I can generate the final documents. And what this will do, this will generate the non-draft proposal, it'll generate the statement of investment selection, which is the investment policy statement, and our investment advisory agreement, and in PDF format for you to review. In certain cases where I know, like, hey, we talked about this, I'll email it to the client, say, John, Mary, here's what we talked about. Take a look at it and I'll call you to discuss, or we'll set up a Zoom or whatever. It's not going to be that easy for you guys starting out. But again, I can do a lot. Again, I haven't generated one piece of paper. Trees are still intact. So now my proposal is complete. And now I can review the proposal. I can then, if I again, I knew this foregone conclusion, it's happening. Client said yes, I showed it to him all on the screen. I'm going to email him all disclosures so he's got it for himself. Still no paper. I can, for the time being, I can either reserve an account number so I can use that on transfer paperwork and things like that, or click get started.
Tom, is there a way that where you can actually push all the stuff to them via email through this system? Meaning, like, if I already put their email address in there, rather than me to take the proposal, the disclosures and save them on the desktop and then attach it to an email, is there a way we could push it through here, or is there?
It's not,
like that?
it's probably not likely to ever, anything that ever used to do that is probably not gonna have any more life because of all of the email gateways and retention and things. It'd be too complicated bypassing stuff.
Got it.
I'm not sure the heck's going on here, but I don't really want to get down that road anyway. So in any event, what I did was I was able to click on that button that sends me over to Pershing's client onboarding, and that's, you can see it's generated the account number already in the proper account range, and it will take me into there to show, all right, now it's going to walk me through the process of opening the account, which if I have an existing brokerage account already set up, I can replicate and take all that data, and opening that account will be a matter of seconds. If I have data in Redtail, I can import the data from Redtail into there so that the amount of information I need to input in there. But ultimately what that will do is generate all of the paperwork, quote unquote, for the client, which you could then press a button and print out said stack of paperwork, bring it to the client and go through and sign. Or you could do it via e-signature, either by sending it to the client, having the client e-sign it, or you can also walk them through the e-signature process themselves using your laptop at their place or your office. Questions?
Do you ever know if there's a way, because Chris has his first opening yesterday, and his buddy specifically said he's not looking to divert any more of his investments into tech, because he already has some that he needs to hold long term. So is there a way to prohibit when searching and funneling down your asset manager, or is there a way to pick an asset manager and simply filter it? Like, I don't want to invest in tech within this portfolio.
Theoretically, yes. What's not tech?
Yeah.
That, and again, this is a good, healthy conversation with the client, because are you saying I don't want FANG, that kind of tech, or I don't want tech? So is that DocuSign? Is that, company like, oh, I didn't know that's not tech. Well, so much is tech. So you have to kind of decide where you want the line drawn. And then that might be, either a research job going through and, finding who's a money manager that is sans tech completely and at what level, or making calls. I mean, again, that might be a bit of a, not a needle in a haystack, but it might be a little bit of a challenge. But if you said, look, you know what, I've got a $1 million portfolio and I'm looking for an SMA manager to manage the money, and I specifically want them to exclude based upon these parameters, well, then what you're going to find is then the money manager is going to say, I can't do that. Or, okay, it's much easier if it's company specific, industry specific, possible. But again, if it's a $50,000 account, use the research, try to narrow it down and find something that's least tech laden. When you got $1 million and you could start throwing your weight around and saying, yeah, customize me a portfolio. Sure. Again, it's, you might also find in the impact side, in the ESG side, a lot of the managers doing a lot of different things there. So it might just be a matter of, making a call to somebody in the investment due diligence team who's going to say, oh yeah, that's, Johnson. They're the anti-tech. What other questions? As I said, we could, we're 2 hours in, and it's not a bad place to stop. I don't have to, but I think after this you start to glaze over. There's a lot of stuff covered. We could spend, more time, do more sessions. From here, what I would do is go back and say, all right, let's look at all the, quickly go back and look at other ways that you could do proposals. Okay. But again, it's all going to be, and with the way the new system lays out, it's much more intuitive. It's going to be much more driven by the client's situation. So, that way you don't need to know what you don't need to know. But we'll go through all of it. But for now, this is a good start, and this is, again, where you're going to be, most of the time. When you get in a complicated situation in the weeds, come to one of us. And if it's beyond my pay grade, we'll call somebody. Anything else that you want me to cover for today while we have everybody? Richard, head flying open?
No, just open it all.
Gentlemen? New guys, old guys, medium guys?
This is a definite to be continued. There's no doubt about that. Just when we first start working on a case, planning out the case and stuff, that's really what you're going to learn most. But this was definitely great. They keep improving, which I like to see, making things easier and easier. So I had, like I said earlier, I hadn't used this new version just yet. So it seems to be much better. Question I do have though is we have the risk tolerance questionnaire in our kits. And you're right, 100%. It drives everybody to the middle and scares everybody. Oh, market's going down 20%. What am I going to do? Well, I don't know what I'm going to do if I have $2 million. That's $400,000. I might make bad decisions. People are checking off the things, and it's driving them all to be moderate investors because if I just lost $400,000, am I going to put more money back in, or am I going to lose? They start thinking about that. So I think that was much better way to present it. So
yeah, I mean, look, there's a lot of tools. There's a company out there, Riskalyze, that does a great job. They're very expensive. I'm not, just at this stage, I'm not gonna go there. Because again, most of my conversations are very simple, very practical. I can get a very good sense and talk them into it and say, again, your risk tolerance isn't what it is when things are great, and it isn't what it is when things are shitty. You got to figure out, are you gonna, if you're moderate, are you gonna be happy being a moderate when the market's up 30 and you're only made 15? They say yes, but sometimes they're like, oh, come on, I didn't think it was gonna be that bad. Well, that's the whole idea. Asset allocation is, mitigating risk by spreading your bets over larger numbers, but it's also watering down the good with the bad. You got to call like you see it. That's what it is. But you know what? We don't know what's going to be good. We don't know what's going to be bad. And anybody that says they do, doesn't succeed at it nearly enough to make it worth all of the headache and the heartache. You know what? And it's not necessarily set it and forget it. But the average client isn't looking for this to be complicated. They want it to be simple. They want it to be turnkey. They want to know that somebody's watching it and that it's forget about what the markets are doing. Your goals are here. You're ahead of your goals. Things are still good. You need to be much more concerned about where you are relative to your goals than anything. And that's why we do draw them back into that whole behavioral finance end of it, is that, look, at the end of the day, you're going to be rich, you're going to be poor, somewhere in between, much more likely because of your behavior than my behavior. I'm going to help it. It's hard for me to hurt it. Okay. But it's about the fact that you did save, that you did accumulate, that you set it up appropriately, that you were tax sensible, and that you invested in the right place. The rest of it is a few points here and there that doesn't hurt, but it's not, I can retire or I can't retire. That's their behavior, our guidance on how they behave. All right. Yeah, just let me know. We want to,
Stop recording.
No, never will.
Money Guy Pro is an interesting, if you go through the whole steps,
Back to your Zoom. Go to Zoom.
Yeah, I'm trying to, I lost my
Oh, you lost your.
pointer.
have you done your time, have you done Money Guy Pro, gone through a whole, mock client step, and it shows you if you, ask them sort of like that, it's 0 to 100 though, and it's saying, what do you feel you are?
Yeah.
And then it'll show that, all right, well, when the great,
Yeah.
stock market crash occurred, this is how much your risk tolerance would have lost. I don't know if you
Yeah,
see that.
yeah, that built-in what if analysis.
Yeah. So, I mean, obviously, one thing that's sort of like scaring them.
Well, you know what, unfortunately it does, but at the end of the day, it's one of those things, I hate to say it's a company that has. It goes through that.